Hi, welcome to this episode. Here today we'll be looking at adjusting accounts for financial statements. The reference textbook is the 17th Canadian edition, Fundamental Accounting Principles, Volume 1 by Larson, Dieckmann and Harris. This textbook. That's the reference textbook for this, and the learning objectives would be the purpose and principles of adjusting accounts, accrual accounting and cash basis accounting, and linking accrual accounting to financial statements, adjusting entries for prepaid expenses, depreciation on unearned revenues, accrued expenses and revenues, linking accounting adjustments for financial statements, adjusted trial balance, financial statements from adjusted trial balance, and correcting entry preparation. So, as was said in the very last episode, we mentioned the accounting cycle in that, and I would briefly talk about it in this. So, you analyze transactions as they happen. When transactions happen through movement of one thing or the other from or to the business, they are recorded first. Then after the recording done by the record keeper or the bookkeeper, or as a first stage in accounting activities. So the transactions will be analyzed in the journals. Then you post the entries, you prepare unadjusted trial balance from that, and in the period things happen that you have to adjust. Then you make the adjustments. Some things were in the business that have reduced, some things have increased, some things were nothing before and have now been added up, have now been opened in the business accounts. All this would be adjusted. Then you prepare an adjusted trial balance. Then from there you prepare the financial statements. And in the past episode we already talked about financial statements. You may check for that and brush up your knowledge in that. So you prepare the financial statements from the adjusted trial balance. Then you close the entries to prepare post-closing trial balance. Financial information must be timely and accurate to be useful to decision makers. The final important aspect of accounting procedures is interpreting and communicating information for end users to have knowledge of the financial position of the organization in order for them to make decisions. So that means the information prepared here must be timely and accurate. It must show true and fair situation of the business. So financial statements need to be prepared at regular intervals, periods. Usually it could be monthly, financial statements that are published outside have to be timely. They could be biannually or annually. And the accounting calendar of a business, in most cases, that you have 12 months. Some organizations, for a changing of accounting policies of one thing or the other, may be plus minus, but average accounting period of many organizations is 12. Then accounts need to be adjusted to ensure all revenues, expenses, assets and liabilities are recorded. Adjustment ensures that the transactions that happen in the period have been effected. For instance, if you had supplies of $10,000 at the beginning of the period and supplies were sold 2,000, that means you need to adjust the supplies account to show the reduction to end the period as $10,000. Otherwise, the supplies would remain as $12,000, which would not show the truth about the position of supplies, because supplies at the end of the period is 10,000 now. It started as 12, but 2,000 was sold out. So this happens, and it shows, when it is recorded, the true situation of the business regarding supplies. All other accounts that have adjustments in the period must be reflected in those accounts, so that the end of the period would reflect the true position of those accounts. The adjusting process and principles. Adjustments are based on three generally accepted accounting principles, which are timeliness, revenue recognition principles, and matching. Timeliness principles shows that, or is a principle that emphasizes that accounting that is prepared must be time framed. There must be a time frame that the accounting is prepared for. It may be for a certain period, so could be January 1 to December 31st of every year. That is the time period. It might be March 1 to February 28 or 29 of every year, of every following year. It may be just calendar month of a calendar period of a business, which is not the same as calendar months. The generic calendar months are January to December. A business month or a business year may start from any month of the year. It may be from March to February. It may be from June to May. It may be from September to, just like an academic institution that will start their sessions. Most sessions or fall sessions start in September. So if a session is starting in September for an academic institution and they want to run a year, it might be September to August, or September to May, or September to June, depending on that business. Then revenue recognition principle is the second one, which insists that all revenues earned in a period must be recognized for that period, whether the revenues have been received in cash or not. Which means the moment a business sells products or delivers goods and services, basically, and the recipient has received it and has acknowledged it. You sell goods to a customer and the customer has received it and has acknowledged the receipt. The business sales must be recorded at that point, even if the customer pays you later. Even if the customer does not pay immediately, the revenue must be recorded for that period. For instance, if accounting year of a business is January to December, and the business sold to a customer in November on credit. On credit means the customer didn't pay immediately, or it is the same thing as sold in account, sold on account, or sold on credit. They mean the customer received the goods but didn't pay immediately. Now, if the customer didn't pay in November, but the accounting year is January to December, and the terms allow the customer to hold on for 3 months. If the terms allow the customer to hold on for 3 months, that means the sales you made to that customer in November, the customer may not pay you in November, in December of that same year. The customer may pay you in January of another year. But the time the customer is to pay you does not matter. The time the customer receives the goods, the time you sold the goods to the customer is what matters, is what must be recognized. So the moment goods are sold, they are recognized. The period a good is sold or a service is provided, income is earned in that period. The customer may pay you later at a later time. That is inconsequential. That does not disregard the sales that has happened. The third one is matching principle. Matching principle matches expenses in a period with the revenues of that period in order to arrive at a profit or otherwise in that period. Which means when a business, all the revenues earned in January to December would be compared against expenses incurred in January to December. Do not forget, as I said earlier, even if the revenues earned have not been received in cash from customers, or even if the expenses incurred have not been fully paid, this do not change the fact that those transactions happened in the period January to December, and they must be matched together. As a result of matching them time to time, like January to December revenues compared with January to December expenses, in order to arrive at a profit or otherwise of that period, revenue minus expenses is equal to profit. So if revenues are more than the expenses, there is a profit for that period. If revenues are less than the expenses, that means there is a loss in that period. That's matching principle. You match expenses with income. Matching principle is also called accrual principle, which means you follow accrual concept of accounting, which takes note of when transactions happen, not necessarily when the payments are made for those transactions. You may sell goods now, but not receive the money now. The recording for sales must take place now, not when the customer pays. The same thing when you have incurred some expenses like electricity, heating and lighting. The period you incur them would be the period of expense, not the time you pay. You may pay later. The time you are paying is not the time the transaction happened. The time the transaction happens and is confirmed is the time it will be recorded for. That matching principle is the same thing as accrual principle. Cash versus accrual basis. In accounting, we really try to differentiate and get to understand the difference between entering information in cash basis versus entering in accrual basis. In cash basis only looks at when cash is paid out and when cash is received, which means if a transaction happened 2-3 months ago but payments are made right now, cash basis would record that transaction for now. The advantage of this is that, okay, it might be considered more objective because it shows the cash right now. Cash that goes out now is recorded now. Cash that comes in now is recorded for now. Even if the transaction had happened previous months, or even if the transaction is to happen in the later time. For instance, prepayments. When there are prepayments, cash basis will record it for now that you are making the prepayments. But yet the transaction would happen later. Or when there are unearned revenues, a customer pays you fund now so that you can sell to them, sell to the business, to their business later. That is an unearned revenue. Or a student pays tuition in advance. To the institution, it is an unearned revenue because services have not been provided. Tuition has not been provided when the student pays a deposit. Or you want to have a reservation of a place, for a place, and you pay in advance. To that organization you are paying in advance to, it's an unearned revenue. So if it is cash basis, it will be recorded. But it is actually an unearned revenue. It has not been earned. The service has not been provided. All this do not matter for cash basis because it would be recorded right then when the cash transaction is being made. That is when the business is paying or when customers are paying into the business. Accrual basis actually looks at the time transactions happen, not the time the cash payments or receipts are being done. Which means if a business sold in last period, accounting period. Let's say January to December is the accounting period, and the business sold to a customer in December last period. Accrual basis would record the sales for the last period, even if the customer is making payments in February of this year, of this next period. Accrual basis will not record cash that is received now for a transaction that was done last period for this period. No, it looks at the time transactions happen, not the time cash is being exchanged for those transactions. When a transaction happens in terms of sales or expenses, it is recorded even if cash payments or receipts have not been done yet. That is accrual principle. And even if there is a prepaid transaction, a customer pays you in advance. Now the customer is paying you. Accrual basis will not record it for sales. Why? Because you have not provided the services, or you have not sent the goods to the customer. So if it is next period that you are sending the good, sales will be recorded for that period. However, cash that comes in will be recorded for cash in cash book, for instance, but it's not a sales established yet. Adjusting accounts. Accounts are adjusted at the end of each accounting period to bring an asset or liability account to its proper amount. Adjusting entries also updates the related expense or revenue accounts. These adjustments are necessary for the preparation of financial statements, because financial statements include balance sheet, which shows assets, liabilities, and equity. So if you have assets, for instance, that you have used up or used part of in this period, you must adjust to show the correct balance at the end of the period. Or you have assets like supplies that you have sold part of, you've used part of, you must adjust it. Or you have unearned revenues account, you must show adjustments to show the part that you have provided, the service, part of the service you have provided. So that the accounting statements would be optimum, accounting statement will be objective, accounting statements will be true and fair. The types of adjustments where I would round off this episode are prepaid expenses, depreciation, unearned revenues, accrued expenses, and accrued revenues. Prepaid expenses. They are expenses of a business that are paid in advance, which means the expenses have not been incurred yet, but they are paid earlier than the time they would be incurred. Example is rent. Rental expenses are paid first before you incur the expense. You would usually pay the lessor or the landlord of an asset first. Now, for instance, then you use the asset up later. So that expense, that rent paid in advance, is prepaid rent. So that means if you paid for 12 months, for instance, you paid for the whole year. Let's say you pay $12,000 for the whole year. That means in your prepaid rent account, it is an asset because you are paying in advance, more or less like saving your money to be used up later. So it goes to the debit side. You remember what we did in the double entry. It's one of the previous episodes treated. You may look up for that to brush up your knowledge in this side, in this aspect. So a prepaid rent would be debited 12,000. Now at the end of the first month, know there are 12 months in a year and you paid 12,000. Technically it means 1,000 is for each month. So if at the end of first month you have used up the space, would you still be having 12,000 unused rental expense? No, you have used 1,000 part of it. That means the balance you should have at the end of first month would be 11,000. Next month you use the place again, that's another 1,000 incurred. That means the balance at the end of second month in your prepaid rent would be 10,000. At the end of 11th month, for instance, you've used 11 months out of 12, and at the beginning you paid 12,000. At the end of 11th month, you have used 11th of 12, 11 of 12th portion, which means at the end of 11th month, the balance should be 1,000, which is meant to be used in the 12th month. This is how you adjust your prepaid expense. And each month that you use up the rent expense account would be debited, but prepaid rent account, which was 12,000 at the beginning, would be credited by 1,000 at the end of each month. Rent expense account would be debited by 1,000 for each month. Rent prepaid account would be credited. Why do we credit rent prepaid account? Because prepaid rent is an asset. We debit it 12,000. So as it is reducing every month, we keep crediting it every month by the proportion of the proportion that has been used up each month, which is 1,000 per month in this case. Depreciation is a reduction in value of assets. There is a video on this episode called depreciation. You may look that up also in this channel to brush up your mind in case. It is a reduction in value of assets. So when you have property, plant, machinery, any equipment, and let's put a value, $10,000, and it's expected to last for more than a year. That means in this year you have used a portion of it up, so it would reduce in value. That reduction in value has to be adjusted in the accounts, so that the final value at the end of this year, which is net book value or carrying value, would show true and fair position of that asset. So accumulated depreciation account would be open, which will be credited. Depreciation expense account would be debited. It is an expense in income statement, and it keeps accumulating every year in the credit side. Then unearned revenues. These are revenues that business has received the funds for, but has not provided services. Example is if a customer pays you an amount for you to deliver goods to them, to their organization, in a period time, a month, a week, or whatever time. This period or this moment that you are collecting the money, it is an unearned revenue, and you must open an account to show that. Cash comes in from customer, you debit the cash account, because cash is an asset. When it comes in, it is debited. Then unearned revenue account. Unearned revenue account is a liability. Unearned revenue account is a liability, and because it's a liability, we have to credit it. Why is it a liability? You are receiving money now on what service you have not provided yet, so it's a liability. And since it is a liability, each month that you now earn the revenue, the proportion that you earn would reduce in the debit side, and your revenue account will be credited. So unearned revenue account, each month that you are now providing, or each period that you are now providing the service, that reduces the amount of unearned revenue. Or if you provide the service all at once, unearned revenue account will then be debited, then your revenue account will be credited, because revenue is an income, it's a credit entry. But when you have not yet provided the service, it is a credit entry, well, it's a liability. Now when you provide the service eventually, or when you send the goods, revenue account proper would be credited. That unearned revenue account that you had before would be debited. Fourth one is accrued expenses. These are expenses that have been incurred already but not yet paid. Not yet paid. Example of accrued expenses would be heating and lighting. Heating and lighting are usually if it is postpaid, it means that you use the heating and lighting for the period, usually every month. Then you can now get a bill to show the amount of heating and lighting you consumed in that period. So that means you incurred expense, heating and lighting expense first, then you pay later. The time you are incurring it, that you're using it up, is an expense accrued. You have not paid. It is a liability because you are owing it. You are yet to pay it. So expense accrued is a liability, which means it will be in the credit side. When you pay it later, then the accrued payment would be credited, accrued expense would be debited because you are making the payments. The last one is accrued revenues. Accrued revenues are an asset. They mean revenues that the business has earned already, but the customer has not yet paid. For instance, if you have sold goods to customers, or you've provided services to customers, or you have sublet the part of the business premises out to a client or a lessee, and at the end of the period the tenant has used up the sublet area, you have already earned that income because the payment should be made to the business. So even if the customer or the tenant has not yet paid, because you have already sublet that place out and has been used by the customer, or you have provided a service that has been used or enjoyed by the customer, even if the customer has not yet paid it up, it is revenue already. So if the customer is owing it, it is accrued revenue. It is an asset. It's an amount owed to the organization. So at this point, I would round off this episode, and if you have any question, you may put it in the comment. And to add up or buttress the points, some things that we have said here: depreciation, double entry accounting equation that we mentioned briefly in this account, have been recorded previously in this channel. You may search it up. You find it in this channel. Thank you, and see you again in the next episode. Bye.